Hi, I'm Henry Elliston from Efficient Portfolio, and I'm going to talk to you today about financial planning through divorce. Um, Presumably, you're watching this video because you're going through that process at the moment, and it may well be that you're worried about things such as have you got enough money, you're going to have enough income to carry on paying your mortgage? Are you going to have a big enough mortgage to keep your family home? It might be that you know that there are some pensions that you need to look at and you need to share, but you're not quite sure what your other half's pension really is, how much it's worth, and how much of it you should collect as a fair share. It might just simply be that you've got to the stage of creating a financial settlement and you just want to understand if that settlement is fair for you and that you're getting the right share of the cake, as it were. So if those are your concerns, wouldn't it be great to find yourself in a position whereby you're free of those worries? You understand that the decisions that you made today were the right ones, and they're going to leave you financially in the right position in the future. So that when you go out on, life 2.0 out on your own, that you can look back on this difficult time, but you can look back on it with comfort in the knowledge that you actually did get the right settlement, that it was fair, and that hopefully now you can lead your life financially free, and taken away from all those worries that you had in the past. So if that's where you want to be, it's vitally important that going forward from here on in, you understand the power that financial planning can provide to you. This is the right time to do it, to get a full understanding and grasp of all the strange technical terms that you might be hearing about defined benefit pensions and what have you, and putting a solid plan in place so that you can go forward, especially in mediations or mediation sessions or with your solicitor, and say, look, I've got this together, I really understand and know what we're doing, and I'm confident that the decisions I'm making now are the right ones. But before we go into that, you might be wondering, who is this Henry Elliston? What does he do, and why is he going to be able to tell me the right decisions that I should be making? That's a really good question. So let me just give you a little bit of a background about me. I started off in the financial planning industry around about 15, 16 years ago. I started off as a mortgage advisor, and I worked on a floor of about 40 or 50 people. And it was a real sales environment. We were told that we had 2 power hours a day, and in power hour we were given a telephone directory, and just call people in that directory, and to get them sat down and to come into meetings. And if we didn't get any meetings in the morning, we were told power hour in the afternoon, we were going to have the telephone receiver sellotaped to our hand, and we just carried on calling. We weren't allowed to put the receiver down until we'd got at least one person booked into the diary. It was a fast-paced, hardcore, exciting in some respects scene, but pretty depressing in others. And to my mind, it wasn't quite what I wanted. I wanted to be a financial advisor, not just to concentrate on the mortgages. And so after a few years, I left there and I went to join a nationwide company called Chase DeVere. And I worked there mainly looking after doctors, GPs, consultants, and helping them understand their pension, the options around their pension, and coming up with some investment advice for them as well. However, Chase DeVere was also a real salesy company, despite the fact we were working with professionals in that sense. All the time, it was the CEO, a chap called Stephen Gaviner, would come up and he would shout at the sales meetings and say, "We've got to sell. If you do a pension switch, charge for it. If you do a fund switch, charge for it. If basically you ever talk to a client, it's a point of advice, we should be charging for it." And to my mind, that didn't quite work. So I moved on from Chase DeVere and I moved to a national accountancy firm called Grant Thornton. The financial planning part of Grant Thornton wasn't a big part, but it definitely wasn't a big salesy institution. Instead, we spent a lot of time with our clients. There was very little pressure on our clients. And that seemed to me to be a better way. It was to get to understand the client, what they wanted, what they needed. But even then, all we ever really did was we then went, okay, I understand what you're trying to do. I understand where you're trying to be. Let's just put your money into this investment. There was still something missing. Unfortunately, it was about this time Charlie Redding, the owner and director of Efficient Portfolio, approached me. He said, Henry, I think I've got a really good idea, but before I tell you about that idea, let me just take you through my career. And interestingly, Charlie's formative stages in his career had been similar to mine. He'd started off on a floor of really sales, pinstripe suits chaps. He'd then left and he'd moved to an independent company called Millfield. And again, Millfield wasn't quite right for him. So he left Millfield and he set up Efficient Portfolio back in 2008. The point behind Efficient Portfolio, however, Charlie had recognized was that not only is it vitally important to be independent, we also need to be creating plans for our clients so that they can understand the value of all the work that we do behind it. And he put this manifesto, if you like, down in his book, The Dream Retirement. And in having the book there, people could understand and see what we were trying to do with Efficient Portfolio. And this led to heaps of things. So Charlie found himself on the news and on the radio. And also we got, we were published in the Sunday Times, the Telegraph, even New Model Advisors should train a trade journal. It became really successful. And Efficient Portfolio to this day is growing really quickly. And the advice that we offer, I think, is excellent, given the experience that I've seen of other companies and the advice that they provide. Not only that, to provide the advice that I do to clients who are going through divorce, which is my primary source of client, I decided to join Resolution. Resolution are the family planning consortium, mainly involved with solicitors, but also with financial planners as well. And also I've got things on Vouch for, so you can see that I do a pretty good job if you care to go on there. As a company, we're authorised and regulated by the Financial Conduct Authority, as you'd expect. And more than that, we're a chartered financial planning firm, and that marks us out as being in the top 14% of companies in terms of qualification across the country. Indeed, I'm also a chartered financial planner and I hold the fellowship of the Personal Finance Society. What's important about this is it shows that we stay on top of our game. We do all the qualifications we need, and the advice that we give to our clients is the very best advice that we can provide. And in terms of that advice, what do? Well, we're truly independent financial planners. So by being truly independent means we don't tie ourselves to one company. We're not aligned to NatWest perhaps, or Lloyd's or someone like that. We look at the whole marketplace and offer what we think is the best solution for each of our individual clients. And that's so important, not being tied into a poorly performing product, for example. And by financial planning, what do I mean by that? What I mean is that we look at all of our clients' assets, and then more importantly, we look at their future goals, their aspirations and desires. And what we're then charged with is trying to allow our clients to live the life that they dream of using the assets they've got. And hopefully, more often than not, we do that. But that's what's really important, not all the bricks that build it, but actually the final goal. Another question that I'm regularly asked, especially by people going through divorces, Henry, I'm already talking to a solicitor, I'm already talking to a mediator. Why do I need to talk to you, a financial planner, as well? And I think that's a really great question. As a financial planner, I believe I form part of a team that work with you. Now, part of that team, undoubtedly, as you're going through divorce, will need to be a solicitor. The solicitor will write up the important documents that need to go to the court and get signed off by the court. The solicitor will also understand precedent and all the law that goes around your divorce process. You may well be working with a mediator as well, and a mediator is there to help you and your other half come to an agreed settlement without the necessary expense, perhaps, of going through a solicitor. Neither the solicitor or mediator are trained and qualified, however, in the ways of looking after your finance, in the ways that a financial planner is. I've done loads of exams, so I know about pensions, I know how they work, I know how they operate. I understand what investments are and what underlies them. I understand how a mortgage works and what multiples of income you can get and things like that. And this is a service that a solicitor and a mediator can't put together. The other thing they can't do is they can't put a proper financial plan together. So they can't sit down and say, if you get this as part of your share of the assets of from your divorce, this is what your future life will look like. All they can say is, from what we can see, this is a fair 50-50 split. And as you'll see through the rest of this talk, actually, there's a whole heap of ways that we can cut the cake. And actually finding the right way to cut the cake for you is really important, because it might not be the obvious way of just saying, I'll have half of everything. So moving on, through this talk, we're going to look at the 5 Ps of financial planning through your divorce. And the first of those is preparation. Now, of course, preparation is vitally important. As a wise man once said, prior preparation prevents poor performance. And it's so true when it comes to sorting out your divorce finances. What most of you will be asked to complete is a financial disclosure form, and this will get passed on to your mediator or to your solicitor. And it's on the back of this form that your negotiations around your finances will start. It demonstrates to both sides what your financial makeup is made of, how much your house is worth, how much your investments are worth, how much you think you spend going forward. Now, it's quite a daunting document because it's long. And with that in mind, I think the best way of going through your 4Me is just slowly, stage by stage. None of it, generally speaking, for most people, is actually that hard to get hold of, the information certainly. So the things that you'll be asked about are, for example, what's the value of your home and what's the value of your outstanding mortgage? Now, the value of your home, admittedly, can one half of the family will want to reduce the value as much as possible, and the other party will want to increase it. But getting an estate agent around, or a few estate agents around, to give you a good understanding of what your property is currently worth is probably a fairly sensible idea, and of course it's free. Understanding how much is left on your mortgage, again, is straightforward. You just need to get an old mortgage statement. The same is true of most of your investments, and you'll find that if you hold things like ISAs, unit trusts, investment bonds, you should be sent on an annual basis a statement that shows how much those are worth. Now, if you're making regular contributions, of course, over the course of a year, that'll go up. And then in really volatile times, like the moment with COVID-19 going around, valuations have fallen a little bit. But it's really worthwhile getting hold of an up-to-date statement and using that to populate your 4Me with. The next step within your 4Me is to start thinking about the budget, because it asks you about how much you think you're likely to want to spend, both now and in the future. And I find budgeting is a really interesting thing that so many people are slightly blasé about. The number of clients that I've seen who earn £100,000 a year take home £5,000 a month. And I say to them, how much do you spend? And they say, well, my mortgage costs me about £1,500 a month, and I probably spend £500 or £600 a month on food. I've got a car, and there's a bit on travel. We go away and I buy some clothes. I reckon in total I'd probably only spend £3,500 a month. And I go, well, that's brilliant. That should mean you're saving £1,500 a month. And they look at me and they shake their head and say, no, Henry, I've got a credit card with £5,000 of debt on it. I've got no savings. And this is because they haven't sat down and really thought about their budget. What are they spending money on, and how much are they spending money on? And so for you, I urge you to spend some time in really getting to grips with your budget. Sit down and have a think about how you spend your money. And don't just think about this month. Go back in time. And not go back for 6 months, for 8 months, to have a look at how that changes. For example, I'll explain to you how my budget looks. In December, it's Christmas, and therefore it's expensive because I've got 2 children. They both need Christmas presents. A wife, she needs a Christmas present. My friends and family who I get Christmas presents for as well. And of course, it's a time of party and celebration. So we all spend a bit more money in December. That's no surprise, is it? Come January, well, actually, of course, You know, we go for a dry January, we stop going out. Anyway, it's cold and raining, and who wants to go outside anyway? So our spending goes down a little bit. And actually, for me, February is fairly similar, and it's a short month, of course, as well. By March, things start to hot up a little bit. My youngest daughter has a birthday in March. Often school holidays coincide with a bit of March too, so there's a little bit more spending that goes on. April, we're okay with. By May, things really start to heat up. I've got one daughter's birthday and my wedding anniversary too. And then by June, it's my wife's birthday. So I have 2 months of really quite high expenditure, followed by July, which is my birthday. I might spend a bit on my birthday for myself. So you see, those months fluctuate. So there's no point in me just having a look and seeing how much I spend in January, because that's rubbish. It doesn't tell me at all how much I spend through the year. Instead, I really need to average out how much I spend over the course of a year. The other thing that it's worthwhile looking at when you're putting your budget planner together for me is, how are things going to change? It might be that you've got very young children at the moment and they're at nursery, and so you might be paying nursery fees, but actually in time they'll leave nursery, and so the cost of those fees will fall. It might be that you hope to privately educate your children, in which case those fees might rise. It might be that you haven't got any children at all, and so this is all irrelevant. But nonetheless, actually you're going to turn 60 in a few years' time, and you really fancy having a spanking party for your 60th, or that you're going to go and take some nice holidays to celebrate the fact that you're out of this marriage now and you're happy, and we want to start the next part of your life well. So there's a nice big cruise or safari that you want to go on. And it's worthwhile trying to build these things into your plan, because whilst this might not be taken into account as part of the divorce settlement, it's important that you understand it so you can start putting those plans together. Now, a useful way that I find of getting all these plans is to use a budget planner. We've got a budget planner that we can happily send through to you. So just drop me a message and we can fire that over. And as I say, if you get your salary in there and all your other expenses, it should give you a really good idea of either how much money you can save every month, how much extra money you need every month, which will come in useful when you start to put negotiations together around child maintenance or even spousal maintenance going forward. Moving on to the second part, or the second P of the financial planning around your divorce, we're going to look at property. Now, with property, I'm going to break this down into two sides. So there's property around the bricks and mortar, your home, and perhaps any buy-to-let properties that you have. And there's the other property that you own, which is in your investments. And so we'll have a look at investments and see how they might work for you as well. But before we do, I'm just going to tell you a quick tale about a client of mine who lives on a canal boat. Now, this client's been very successful. He's had a successful career in manufacturing in the Midlands, but what he hasn't quite been so successful in is his love life, and he's been divorced twice. Now, for Roger, for the first time he got divorced, they owned a family home. He had his defined benefit pension that he was saving towards, and his decision was absolutely, I've no interest in giving up my valuable pension, but my wife can have the house. And then life went on, and he carried on saving towards his pension. And as he got married again, and at this point he decided that actually, when I retire, what I'd quite like to do is I'm going to buy a canal boat. And our summers will be spent going around the canals of the southwest of England, which sounds like a lovely idea. Then we've got our home to come back to when it gets a bit cold and wet and rainy. Sadly for Roger, he got divorced again. And again, he made the decision that actually he would give up the family home to keep this really valuable pension. And then he retired a couple of years later. Well, by this stage, he had no way of getting hold of a mortgage because he had no regular income, he had no salary. So his only option has been to take a lump of cash from his pension to buy himself a canal boat, which he does sell in the summer, but also he's now forced to sell this thing in the winter. And I'm led to believe by Roger, it's not quite so much fun when it's blowing a hoolie outside and there's actually waves on the canals. The point of this is it's really important to understand what you can afford and the value of the decisions that you make today and how those might go to affect you in the future. Now, in terms of the mortgage, it's worthwhile talking about that. A lot of you will be married at the moment, and therefore when you took out any mortgage, the mortgage will have been based upon your joint earning capacity. Now, for some people, that might not have been a problem. You might not have stretched yourselves to the maximum mortgage available, or you might have taken out your mortgage many years ago and been fortunate enough to repay an awful lot of it. Others of you, probably a bit younger, would have started off, you won't have paid much of your mortgage off, and now this will become a bit of a concern. It's really important when you go towards that first mediation session that you understand how much realistically, not only you can borrow, but how much you can afford to service. Now, in terms of how this works, there are two things that most mortgage lenders are going to look at. They'll look at your salary to determine how much you can borrow, and they'll look at the level of equity held within the property, your deposit, for example, as to what they will charge you. Now, in terms of how much you can borrow, I mean, a typical rule of thumb is you can probably borrow around about 4 times your income. But this is dependent upon you not having lots of other debt. It depends upon you earning a reasonable salary, because without those earnings, then of course your disposable income that you can put towards mortgage repayments is squeezed a lot more. So if you earn £20,000, 4 times your salary is about £80,000, probably works out, provided you haven't got £10,000 on a credit card. For some, for higher earners, actually, it may well be that some lenders will provide you a little bit more than that, and they'll give you maybe 5 times, which is, I think, about the maximum you can get at the moment. So for someone earning £50,000 a year, getting hold of a debt of £250,000 might not be beyond the realms of possibility. The next thing is how much they're going to charge you. Now, at the moment, mortgage debt is extraordinarily cheap. In fact, I think there was a 2-year fixed rate I saw the other day for under 1.3%. Now, the way that lenders will determine how much they're going to charge you is how much risk they're taking to lend you that money. Now, the minimum amount of deposit, generally speaking, is probably about 5%. But really, the rates start to get better once you've put about 20 to 25% deposit down on the property that either you're living in or that you're moving to. So with both of these ideas, one, how much can you borrow, and 2, how much is it going to cost me? Before getting into mediation, I can't recommend strongly enough getting a meeting with a mortgage advisor and asking them those 2 questions. They'll be able to tell you pretty much straight away. Most of them won't charge for their time, and it'll give you a really good understanding then of, can I keep this property and continue to service the mortgage? Because if you can't, there's really very little point about starting and opening up that argument, which just doesn't help anybody. And one little story I have heard of a lady who was so keen to keep her family home and who didn't really think about the whole plan, was that after the divorce was agreed, she kept the family home and the husband took away most of his pension and investment. 6 months later, she recognized that she couldn't really afford the mortgage. And so she sold the family home and bought a new one with a new mortgage on it. But she didn't think carefully about that new mortgage. Indeed, she had to sell that second home and buy a third, smaller home, whereby she could service the mortgage, and actually it was not too much of a struggle for her. And the problem that's so sad about this story is not only did she not take some of the investments and pension assets that should have been hers and would have served us so well in the future, but also she had to pay 2 sets of estate agency fees, 2 sets of stamp duty, and it has really put her finances on the back foot. So getting this as a fundamental part to your financial planning. Now, let's say you don't want to keep the family home, but you're quite happy to sell it. One thing we need to consider is capital gains tax. And this neatly links the 2 different sides of property together, the bricks and mortar and the other investments. Capital gains tax is a tax that's charged on the gains that you make on an investment. Currently, it's 10% or 20% on investments, depending upon whether or not you're a higher rate taxpayer. And you've got a £12,300 allowance that you can use every year before any tax is charged. If you've made your gain through property, through the sale of a property, a residential property, the rates of tax are higher. They're 18% or 28%. One saving grace, however, is that you get something called principal primary property relief. And what that means is that if you're selling your main home, you don't have to pay any tax at all. It's great. However, where you do need to be careful is if you've moved out of the family home and you've perhaps started renting somewhere, or you're looking to buy somewhere. Now, this is a problem because it's no longer your family home. So to overcome this, you do get 9 months grace. But if you've been separated for longer than that, this can become an issue. And recently I was talking to a couple who bought a family home and had been separated for 10 years. And there'd never been a need or desire or drive to divorce, but now they had got to that stage. Sadly, for the one half of the family, they are now likely to be leveled with quite a significant capital gains tax liability because of the growth in that property over the last 9.25 years. So it's worthwhile bearing this in mind if you are moving out and seeking advice from a qualified professional to help make sure you don't have a tax liability, or if you do have a tax liability, that you know what it is. The other thing to say is that whilst you are married, assets can be passed freely from one spouse to another spouse without giving rise to any tax. Now, this might be especially important if you own stocks and shares and you're trying to balance up your division of assets between one another. Because let's say you own one share and you've made a whole heap of money on the share, brilliant. But actually, now that you're going through divorce, it becomes apparent that actually it would be better for your other half to have some or all of those shares as part of the divorce settlement. That's fine, but make sure that transfer goes through before decree absolute, because after decree absolute, it's likely you're going to have to pay capital gains tax on the slug of money that you're passing over to your other half, and nobody wants that. So foresight and careful planning is order of the day. Now, moving on to those other investments, what are they and how do we look after them? Well, this is true for a whole range of different assets. So you may well have ISAs, stocks and shares ISAs especially. You might have unit trusts, investment bonds. In fact, this is even true for pensions, defined contribution pensions. Generally speaking, underlying all those investments, you will have a portfolio which will be invested in lots of different things. There will be things such as stocks and shares in the UK, but also maybe stocks and shares in Europe or in the United States or in what we call the emerging markets or Asia. And all these stocks and shares will hopefully grow and over time create a much more valuable portfolio for you. Your portfolio might also be tempered with less risky assets. So things like government bonds or even just straight cash holdings. So these are things that hopefully don't bounce up and down in quite the same way that the stock market does, but will just create some stability to your whole portfolio. And then your portfolio might also have little other bits and pieces in it. So you might find there's some commodities and gold or oil stocks in there, or you might find there's some commercial property, just to add different bits to your portfolio, so that hopefully as one bit falls, you've got other bits that will make up for that loss. Now, the way that your portfolio is balanced will depend upon the levels of risk that you're happy and comfortable taking. Now, this is really important if you're collecting a portfolio from another half as part of a divorce settlement, because one hopes your other half has had that portfolio designed for them. It won't have been designed for you. So as you come to inherit that money, you then need to make the decision as to how is it best to invest it for my benefit. Now, it might be that you're young, you've got a long way to go until you retire, and you're not going to need to get a hold of this money until then, in which case you might position your portfolio in quite a risky way, because the higher the risk that you take within a portfolio, it tends to be that the higher the returns you collect over the longer term. It might be that you've already retired when you're collecting this money, And therefore, actually taking huge amounts of risk to grow the portfolio is not important. Instead, what you really want to do is just try to make the money grow at least over and above inflation. And this is where cash savings can be really bad. Because, of course, cash is great because it provides you with an emergency fund. You know it's always there and you can lean on it. But if you look at this chart, you can see that over the course of the last 10 years, actually the value of your savings has gone down by almost 5%. And that's simply because at the moment, interest rates are 1/4%, and the target inflation rate is 2%. So therefore, if you're just getting 1/4% in your cash account, but actually inflation's running at 2%, you're losing 1.75% in the buying power of your money. And that's why taking care of your portfolio to ensure that it beats inflation over the medium to long term, and that the right proportion of your overall asset pool is invested, is so important and must be reviewed, especially at this big change in your life, to make sure it's doing all it can for you. The next P in planning for your divorce is your pension. Now, this is it's quite a complicated part to your financial plans, and certainly when you talk to solicitors, they'll make quite a lot of noise about it. Before spending time considering what the different sorts of pensions are, I think it's first worthwhile thinking about the different ways in which pensions can be shared. And indeed, this is largely true for all your assets. But there are three main ways. The first way is to offset your pension. And what I mean by offset it is that you take the value of your pension and rather you collect, or your other half pension, rather than collecting that, you take another asset. So the most common way of this, for example, would be, I've got a pension that's worth £100,000. There's £100,000 of equity in the family home. So I'll keep my pension, you keep the family home, we're all square, we got £100,000 each. Clearly, depending upon the complexity, it might be more nuanced than that. The second way is called earmarking. Now, with earmarking, what we do is this works particularly with defined benefit pensions, whereby there's a regular income that's going to be paid from a given date. Although it can work with defined contribution pensions too. But with that, what we're saying is that I'm going to earmark a part of the pension. So let's, for example, say my pension is going to pay me £10,000 a year. You might take out an earmarking order on my pension that pays you 1/4 of my pension. So therefore, when I retire, you collect £2,500 a year. Now, there are some drawbacks with earmarking. One, you're really reliant upon me. So I've got to retire in order to start paying you a pension. And I might not retire because I don't want to, or because actually I know it's going to upset you. And as we've got divorced, that might happen. And thirdly, if I die, my pension may well die with me, in which case, so's your income. So there are some drawbacks to earmarking orders, and one needs to be very careful about entering into them. Because there are drawbacks to earmarking orders, there is now another way, a relatively new way, and that's pension sharing. And the benefit of pension sharing is that it means the pension is no longer held in my name, but instead it becomes held in your name. So, for example, if I have £100,000 pension pot held in my name, and we agree for a 50% pension sharing exercise, it will mean that 50%, £50,000 in this case, is now yours. And that pension, under court order, will be transferred into a pension pot held in your name. If this is the case, it'll come across as cash, and you then need to make the ongoing investment decisions as to how best those funds are looked after. But that's how a pension sharing order works. And of course, depending upon how your assets are all broken up, it might be that you do a little bit of pension sharing and a little bit of offsetting, or some earmarking. There's a defined benefit pension scheme. These all work together. There's not one thing that you have to do at the expense of all others. Moving on to look at the different sorts of pensions, and there are two different types of pensions that we need to concern ourselves with. The first is called a defined contribution pension. Now, this is very common today. Most people will have one, and simply speaking, it is a pot of money that you save towards, normally on a monthly basis, and quite often your employer will save towards it too, certainly under the new auto-enrollment rules. So with this pot of money, you drip feed money into it. It's invested normally in the market. You might have decided on that portfolio, or it might be invested in just the default fund. And over time, it grows and grows and grows. And then when you get to retirement age, you have a couple of options as to how you fund your retirement. You might buy an annuity with it, with this pot of money, and that will provide you with an ongoing income for the rest of your life. Sadly, annuity rates at the moment are very, very poor. Therefore, for a 60-year-old with a pot of money worth £100,000, they might only get £2,500 a year or £3,000 a year for their £100,000. And so with that in mind, pension freedoms came about, which really opened up flexibility. And what that allows you to do is to say, I've got my £100,000, I'm going to draw down whatever money I need from this £100,000. And that comes with its own benefits, because it means in the early years of your retirement, maybe you can draw a bit more down, understanding that as you get older, you're not going to need so much. But also it comes with its risks, and the risk is that the money runs out. And that might be because you've been drawing too much from it, or it might be that the markets have fallen at the wrong time for you, and the pot becomes too small. So you need to be very careful with how you look after your defined contribution pots. The other sort of pension is a defined benefit pension, also called a final salary pension. Now, with a defined benefit pension, what happens is your final benefit, your pension, is defined by your service within the scheme. So what you might find is that the scheme will pay a fraction of your final salary for every year that you worked in the scheme. So, for example, the one scheme might pay you an 80th of your final salary for every year that you've worked there. So if you've worked in a scheme for 40 years and you earn £100,000 by the time you leave, 40 divided by 80 times 100,000 means that you would collect a pension of £50,000 a year for the rest of your life, which is pretty decent. It might not be final salary that it's based on. Sometimes there are other measures. So your career averaged earnings, for example, whereby they look at the whole of your service within that group and take an average of that income. Or sometimes they look at the last 10 years or the last 3 years and take an average of those figures. And of course, it's not necessarily 80, it's different schemes will work with different numbers. So more generous schemes will often work on perhaps 60th, 50th, and I think I've seen 40th in the past. More often than not, defined benefit pensions will also provide a spousal benefit, which might not be of so much interest to you right now, but a spousal benefit will often pay half of my pension to you if you survive me, or 2/3 of my pension, and sometimes also additional benefits to children as well who remain financially dependent upon you. So these defined benefit pensions are fantastic in the sense that they give you a lot of guarantee. You don't have to worry about investment returns or anything like that. You know that you're going to collect this income forever and ever and ever and ever until you pass away. What they don't have, strictly speaking, is a pot of money behind them, a big pot of cash like you will have with your defined contribution scheme. And so this makes it a little bit tricky when you're coming to work out how to share the asset. Now, with my defined contribution scheme that's worth £100,000, well, it becomes relatively straightforward. We're going to split everything down the middle. Okay, £50,000 each. With a defined benefit scheme, it's harder. Let's say my defined benefit scheme does pay me, as like my example a bit earlier, £50,000 a year. And it's got a Therefore, if we're going to split it halfway, we'd get £25,000 each. Now, that might work. And some firms, or some pension schemes, will allow you to actually split the benefit that's being paid between two. The NHS is a very good example. Some pension schemes won't allow you to split that income. And instead, what they offer you is a transfer value. And they'll say, yeah, fine. So for this £50,000 pension pot, I'm going to offer you a transfer value. And the transfer value could be anything. And I've seen between 10 times or 15 times the pension that's paid to over 40 times. And it's understanding how this will then affect your future pension planning that becomes very tricky. So if it's £50,000 times 40, that'll be a £2 million transfer value. But a 10 times would only be £500,000 transfer value. And understanding how that's going to affect your pension in the future and what becomes a fair share is hard and does take time. And really, you should be seeking advice before making those decisions. The next of the 5 Ps of financial planning is the planning. And this is possibly the most important part of the whole piece. But I just feel before you get to the planning stage, you've got to understand what the other assets are in your pot and what the budgeting looks like and everything like that before you can really get involved in the nitty-gritty of the planning. However, to give you an example of how this can really benefit someone, I'm going to take you through, there's a real life example of a client that I work with who's getting divorced. So to give you a quick overview, this client had a property that they lived in, this couple had a property they lived in that was worth about £500,000, didn't have a mortgage on it, happily. They had a buy-to-let property that they owned as well that was worth about £250,000. She had a small pension worth about £30,000 and he had a much larger pension worth about £400,000. When we sat down and I spoke to her in detail about how she saw the future, it was apparent that she really wanted to keep the family home. She was going to carry on working and she earned about £50,000 a year, but she didn't think she was going to get huge amounts of promotions from there. She was very comfortable in her job and really enjoyed it. So that's fine. And she explained to me that her ex had actually started going out with another girl. She lived up in Manchester and she suspected that he probably wanted to move up to Manchester to be closer to his girlfriend. So that's all okay. So we started to put a plan together. And this was the initial plan that we put together. So in this chart, each of the blue lines that you can see is the income that this girl earns in a year. So you can see it comes out at about £50,000. The black line beneath it shows how much she spends every year. And you see there's a couple of peaks along the way when she buys a new car, I think that was. And then she gets to her mid-60s and her income falls significantly because she's no longer working. So she's now reliant on just a pension. And then by the time she hits her mid-70s, the blue bars start to turn red. And that's because she's run out of money. And actually that blue bar at the bottom just represents her state pension. And this can be seen if we then look at her liquid assets. So we can see over the period at which she's working, the green bars, which represent her pension, increase in value. The blue bars are some investment assets that she holds, remain steady, and then she's got some cash as well, which isn't growing quite with inflation, which is why it's falling in value a little bit. But as soon as she retires, the value of the assets falls very rapidly indeed. And as I say, she's out of money by the time she's in her mid-70s. So we then had a look at a couple of scenarios to see how they best worked for her. So in this next step, we modeled him transferring £75,000 of his pension to her. Which is great. It meant that her pension was topped up a little bit. The assets were shared fairly between them insofar as they both had similar amount of assets. He got the buy-to-let, some of his pension. She got the home, the equity, well, all the home, and a bit of his pension on top of her own pension. So as we can see, when we plug this into it, she now lives happily all the way through her life, and actually she gets to her early 80s before she runs out of money. And again, this can be seen in this chart. So we see actually her pensions start building from a slightly higher level. They carry on growing while she's working, and then they fall away. And as I say, by the time she's 82, she's run out of money. This wasn't quite the right way of doing it, however, because what it still meant was that the husband had a lot of his assets tied up in the pension, which he couldn't access because he wasn't 55. It meant that he had a property worth £250,000, which wasn't quite enough to buy the property that he'd seen up in Manchester that he wanted to move to. And indeed, for my client, she still runs out of money when she's 82. And given that the average age for a woman now is about 84, it looks to me like she's going to run out of money a bit too early. So we came up with a different idea. And in this idea, what we said was, why doesn't my client take out a £125,000 mortgage on the property? This is easily affordable. She earns £50,000. She was in her 40s, so she had plenty of time with which to repay that mortgage before she got to retirement. This money that she drew out of as a mortgage, she was then going to pass over to her ex, and in return, her ex was going to pass her an additional £125,000 of his pension pot. So as we can see, now we've managed to push her financially free life, if you like, all the way out now to her mid to late 90s. So she doesn't run out of money now until she's 95, which is a lot better than it was before. Given that it was her mid 70s at the first rate, so we found another 20 years of living in retirement, and you see this works in the cash in the liquid asset chart, and that she's just got this much slower, steadier withdrawal from her pension base, and that's because she's managed to build up a much greater pension in that time, having that extra 125,000 put in. The other benefit to this was that the husband then had 125,000 pounds of cash plus the buy-to-let property, and he could then sell the buy-to-let and go and buy this property up in Manchester that he was keen to go and buy. So actually, everyone left much more satisfied than they would have been had everything just been split down the middle, where she wouldn't have kept the family home, it would have been divvied up into equity, stamp duty being paid, and all the rest of it. This is the real benefit of planning. And this is where I believe solicitors won't be able to help you, because they won't be able to see how these changes to a portfolio will affect you both now and in the future. Moving on, the final piece of the puzzle, to my mind, and this is important, is protecting. So protection, and by this I mean life assurance policies that you might have in place, critical illness policies, income protection policies, and what have you. I think there are two sides to this. The first side is that if you've got a mortgage, more often than not, people take out a life assurance on a joint life basis to cover the cost of the mortgage, so that if one half of the family dies, then the other half collects a payment and they can use that to pay off their mortgage debt. Very sensible, very wise. However, if you're getting divorced and it's just going to be you looking after the home, do you really need to have your other half still on that life assurance? Because actually it becomes irrelevant now as to whether or not they die. Similarly, the same might be true of critical illness policies. You may well wish you loved them, and you may well want to benefit if they were to collect cancer or something like that. But is it worthwhile you paying the premium for that policy? On the other hand, is it worthwhile now reviewing the protection you've got in place? So especially if you're a parent, have you got sufficient protection in place in case the worst happens to you, so that your children are going to be well looked after and can maintain their standard of living, even with you not around, or with you suffering a really a nasty illness and having to take a lot of time off work? The other thing that's important is if you're benefiting from child maintenance payments or spousal maintenance payments, what happens if your other half passes away? So whilst you're still married, you have insurable interest in one another. And this is the opportunity to actually say, well, I'll tell you what, our children have got another 15 years until they're going to be financially free, and I'm going to require some form of spousal maintenance for all that period, or child maintenance for all that period. So what I want to do now is to ensure that whatever happens to him or to me, we've got sufficient protection in place that we can continue to pay for and look after the children. Because after your divorce, you no longer have insurable interest on your other half, for good reasons. Otherwise, everyone would be taking out insurance on other people's other halves and topping them off and doing away with the insurance proceeds. So this is why, before the decree absolute comes through, working this through is such a sensible and clever idea. So let me just take you through the process that we take our clients through. The first stage is that we offer our clients a free 15-minute consultation over the phone. This is simply to get an overview of your financial position and to see that we're best placed to help you. If we are, fantastic. What we'll then offer to do is to invite you to an exploration meeting. Now, as I record this, we're all locked down. So that exploration meeting may well happen over Zoom, or it might be that hopefully we can meet up face to face, which is certainly my preferred way of doing business. Within that exploration process, what we're looking at is we're going to look at your 4Me, we're going to look at your budget planner and how that's all come together. And if you haven't managed to do that, we can help you put all those facts and figures together. We're then going to spend a lot of time talking about your future and how your future looks, so that we can then go away and put a plan together for you. And we call that the efficient financial plan. And to put that plan together, we will charge you a fee, and it's a fully refundable fee. So if you think the plan's absolute baloney, we'll give you your money back, no questions asked. Within that plan, we're going to look at the assets that you have or that you think you might collect. And we're going to arrange them in such a way that as many of the bits that you want to do in the future, we can tick off. So if that's, I want to go on a cruise every year of my life through my retirement, and that's really important for you, we want to work a plan that allows you to do that. We can't work magic, so we'll only show you what can and can't happen. But if we can do that, fantastic. To go through that plan, we'll then have a planning meeting. And the planning meeting allows us to sit down together and for me to go through the plan with you to explain it. There might be some complicated terms in it, and that's great. We can go through and explain those terms. There might be some tweaks that you want to make to it. So rather than going on a cruise every year through your retirement, you might say, well, actually, Henry, I've had a bit of a think about it, and I only really want to go on a cruise every 5 years. But I do want to take the family away on a couple of holidays and spend a bit of money on my 60th and 70th birthday parties. And if that's the case, great. We can tweak that and we can work that into the models that we have. And hopefully you like some of our ideas. And if you do, we'll then go away and put those in practice. And that may well be that you get a pension sharing order in due course. And should that be the case, we can then take the court order and write off to your other half's pension company and arrange for the pension share to be paid to your pension. Importantly, after all that's in place, what we then arrange for is the progressive review program. And the progressive review program allows us to sit down on an annual basis and review how we're getting on with that plan. Now, this is so important because one thing I do know is your plan will change. And your plan will change because different things happen to you. You might go and meet a new person. You might want to retire a bit earlier, or actually really fall in love with your job and want to carry on working for longer. You might have a windfall, you might have an inheritance, or indeed something bad might happen, you might fall ill or something like that. So we need to keep reviewing that plan to keep on top of it and then make any adjustments as and when they need to be made. In summary, what we're going to do is plan for you, create a sensible investment solution for you so that we know that you're investing in line with your risk profile and for the future so that we can hit those goals. And then we're going to review the progress that we're making on an annual basis. So the next step, if you think we can help, is simply to get in touch and arrange a free 15-minute personal finance call. We just sit down, quick talk about where you're at currently and how we might be able to help in the future.